We are now going to look at the calculation of economic value added, or EVA. And up front, I want you to understand that the mathematical logic of this formula follows exactly the same logic as the residual income formula. We are comparing their actual return to the minimum required return. So if we calculate a positive EVA, that means value has been created and the division has performed well. If we calculate a negative EVA, that means value has been destroyed and the division has not performed well. So you can see the discussion just above. EVA extends the traditional residual income measure by incorporating adjustments for distortions that are introduced by accounting standards. So guys, if you go back to our calculations where we looked at residual income, the last disadvantage of residual income that we discussed is the short term is emphasized. So managers focus on the short term and they don't necessarily make decisions that are in the best interest of the company in the long term. Now, economic value added is trying to overcome this disadvantage. And what EVA is trying to do is encourage managers to concentrate on the delivery of shareholder value. In other words, we are trying to rather focus on what is in the best interest of the company in the long term instead of the short-term focus. Now, I want to show you how to perform this calculation by working through the example below. So below we have the financial results of Siberian Enterprises for the 31st of December 20X4. We have their revenue, operating costs, operating profit, finance charges, tax, and their net profit after tax. We then have some other information. The total operating costs include depreciation of 4 million rand and research and development of 3.5 million. So that's sitting in these operating costs over here. The economic depreciation for the year is estimated at 5.5 million. Their non-current assets have a market value of 18.3 million rand. They have a net working capital of 8.6 million rand. So please remember your net working capital is just your current assets minus your current liabilities. Research and development costs relate to a new project that will be developed over 5 years and is expected to be of long-term benefit to the company. 20X4 is the first year of this project. So you can see I'm just giving you more information about these research and development costs above. Siberian Enterprises has a weighted average cost of capital of 12%. And we need to evaluate the performance of Siberian Enterprises for the year ended 31 December 20X4 using EVA. So please go back to the formula on the previous page. We calculate EVA by starting with our adjusted NOPAT. And just below you can see NOPAT is your net operating profit after tax. So please note we are dealing with our operating profit. So that means this is before interest, because interest is not an operating cost, it is a finance cost. And then we deduct the tax that is paid. So please note, net operating profit after tax is after tax. However, it is not your tax expense as per your statement of profit and loss and other comprehensive income. It is the tax that is actually paid during the period. Or in other words, it is the cash flow and not the expense on your statement of profit and loss and other comprehensive income. So for this example, let's first calculate our net operating profit after tax, and then we'll come back and have a look at these adjustments over here. So this is my operating profit before interest, or before my finance charges. So that's going to be the starting point in my calculation, and then I'm just going to need to deduct the tax that was paid during the period. Now, this is your tax expense. It's not the tax that is paid during the period. However, in this example, I don't have any opening or closing balances in terms of money that I owe SARS. I don't have any deferred tax. So it's safe to assume that that is a cash flow. But what you do need to take into account is if we are working with operating profit over here, we are working with our profit before our finance costs. However, you know that finance costs are tax deductible. So that means when we perform this tax calculation, we would have had a tax deduction for these finance costs. Now, it's very important, if we are working with operating profit and we are ignoring interest in our calculation, then we also need to ignore the tax consequences on that interest amount. So if you look at my calculation on the next page, I start with my operating profit, which is my profit before interest and tax. I then need to deduct the tax that is paid during the period. So I take the tax expense as per my statement of profit and loss and other comprehensive income. Because there were no opening or closing balances that I owe SARS, there was no deferred tax, that is my actual cash flow. However, you need to be careful. When we calculated the tax expense over here, we would have got a tax deduction for the interest or the finance costs. However, we are working with operating profit in this calculation, and operating profit specifically excludes interest or finance costs. So if we are excluding the interest or the finance costs from our calculation, we also need to exclude those tax consequences. So please note, your tax expense will actually be higher if you exclude that tax deduction. So when the company performs their tax calculation, they will get a deduction for this interest amount. So that 560,000 Rand is my finance cost. That is my interest amount. When I'm calculating the tax I need to pay across to SARS, I get a tax deduction for that. So I now need to add that back. So take that, multiply it by 28% and add it back. Because the logic is I am working with operating profit. Operating profit excludes any interest or finance costs. So I also need to exclude the tax consequences of the interest or the finance costs. So if I'm excluding the tax consequences, the tax expense or the tax that I pay will actually be higher because I won't have that tax deduction for the interest. We then need to make certain adjustments to net operating profit after tax. And we take these adjustments into account in order to overcome distortions that are introduced by accounting standards. So in terms of IFRS, we are required to depreciate assets over their useful life. So on our statement of profit and loss and other comprehensive income, we have a depreciation expense. However, when calculating EVA, we are going to add back the accounting depreciation, and instead we are going to deduct economic depreciation. And economic depreciation is an estimate of the true change in the value of the asset. So we are trying to overcome this distortion that is introduced by accounting standards. So if we look at my example, we have a depreciation expense of 4 million Rand. We need to add that back, eliminate it. Instead, we are going to deduct economic depreciation. And economic depreciation is just an estimate of the true change in the value of the asset. So this year, the asset has decreased in value by 5.5 million Rand and not by the depreciation expense of 4 million Rand. So if you look at the calculation, add back your accounting depreciation and deduct the economic depreciation. Then with EVA, please remember we are trying to overcome the short-term focus of residual income. So if the company incurs any costs that will benefit them in the long term, so over a period of longer than 1 year, so any advertising, training, or research and development costs, then these costs should be capitalized. So we don't want to penalize managers for incurring these costs because these costs are beneficial to the company in the long term. So instead of expensing these costs, we allow them to capitalize these costs, and instead we expense them over the period that the benefits are expected to be received. So in my example over here, we had research and development costs of 3.5 million rand, which are sitting in operating costs over there. So the full amount has been expensed. So obviously, these costs do not qualify for recognition as an asset in terms of IFRS. The full amount is being expensed. However, if we are trying to evaluate a manager's performance using EVA, this is going to create a long-term benefit for the company. So we want to encourage managers to incur these costs. We don't want to expense the full amount in this period. So what do? We capitalize it, we treat it as an asset, and we write it off over the period that we expect to receive the benefits. So in this example, we are told that the research and development costs relate to a new project that will be developed over a period of 5 years, and it will be of long-term benefit to the company. So we are going to capitalize the cost because it has a long-term benefit, and we are going to write it off or expense it over a period of 5 years. And please note, 20x4 is the first year of this project. So what are we going to do? We have an expense of 3.5 million rand. We are not going to expense it. We are going to capitalize the 3.5 million rand, treat it as an asset, and write it off over a period of 5 years. So we will expense 700,000 rand per annum. So look at my calculation just below. I've just added back 2.8 million. However, this is the logic behind that calculation. I'm adding back the full cost of 3.5 million rand because I'm not going to expense it. I'm going to capitalize the cost and write it off over a period of 5 years. However, 20x4 is the first year of this project. So we do need to write off 1 year in this period. So we are going to expense 700,000 rand in 20x4. So the net effect is I'm adding back 2.8 million rand. Then, EVA attempts to convert accounting figures into cash flows. So if we have any non-cash expenses, those need to be eliminated. So for example, if there's any movement in provision for bad debts or anything else that's not a cash flow, that should be eliminated. In addition to that, any movements in deferred tax should also be eliminated because once again, we are working with cash flows. So we are deducting tax paid in our calculation, and deferred tax is not a cash flow. All right, so in our example, we didn't have any other non-cash expenses, any movement in our provision for bad debts. We didn't have any deferred tax. So in our example, that is our adjusted net operating profit after tax. We now need to look at the second part of the formula, where we calculate our minimum required return. And we perform this calculation by taking our adjusted capital employed and multiplying by the divisional weighted average cost of capital. So how do we calculate our adjusted capital employed? Capital employed is just your total assets minus your current liabilities. So please note, guys, you can perform this calculation in one of two ways. And the logic behind this is, remember, your statement of financial position always balances. Your assets equal your equity and liabilities. So if we look at a basic statement of financial position, we have non-current assets, we have current assets. The sum of that together obviously gives me my total assets. We then have equity, we have non-current liabilities, and we have current liabilities. And if everything is done correctly, this should obviously balance. So when we are calculating capital employed, we can perform this calculation in one of two ways. Either we can take our total assets and deduct our current liabilities. So take the total assets, deduct your current liabilities. Please note the net effect is that is going to leave you with the value of your equity plus your non-current liabilities. So depending on how they give you the information in the question, either you perform the calculation by taking your total assets minus your current liabilities in order to get this balancing figure over here, or you can perform the calculation by taking the value of your debt, so your non-current liabilities, and adding the value of your equity. So obviously, regardless of the way you perform the calculation, you should get exactly the same answer. However, what is important to note is you should not use historical costs as per your statement of financial position in this calculation. You should rather use market values or replacement values where possible. So in this example, I've given you non-current assets with a market value of 18.3 million rand, and I've also given you net working capital of 8.6 million rand. And remember, your net working capital is just your current assets minus your current liabilities. So in this example, we will be following this approach where we take our total assets, our non-current assets, and our current assets, and we deduct our current liabilities. So that's the value of my non-current assets and my net working capital. Then please just remember, we said we were going to capitalize these research and development costs and expense them over the period we expect to receive the benefit. So we capitalized 3.5 million rand, and in 20x4 we expensed 700,000, which means we are still sitting with an asset of 2.8 million rand. So please note that is going to affect your capital employed because it is an asset. So that must be taken into account in your calculation. We can then wrap this up and calculate EVA. We take our adjusted net operating profit after tax, so this amount over here. We deduct our adjusted capital employed. It's the adjusted capital employed because it's been adjusted for the research and development costs that were capitalized. So take your adjusted capital employed and you multiply by your divisional weighted average cost of capital. So just above, I told you, Siberian Enterprises has a weighted average cost of capital of 12%. So you can see we have a negative EVA. So please remember, a positive EVA means that wealth has been created. On the other hand, a negative EVA means that wealth has been destroyed. So Siberian Enterprises is currently reducing economic value as they are failing to cover the economic cost of capital, and in the long term, this will have a negative impact on shareholder value. So how can they improve this? How can they correct it? Either they need to increase their adjusted profit, because obviously if this figure over here increases, that will have a positive impact on EVA, or they need to reduce their capital base. So this adjusted capital employed, if they reduce that, that will also have the impact of increasing EVA. So how can they reduce their capital base? They can identify underutilized assets and sell those assets, so decrease their asset base. Or alternatively, they need to reduce their weighted average cost of capital. because if we reduce this weighted average cost of capital, that will also cause EVA to increase. So let's go through the advantages of EVA. The first advantage is exactly the same as what we looked at with residual income. Because remember, I told you EVA follows exactly the same mathematical principles as residual income. And we saw with residual income that managers are encouraged to act in the best interests of the company as a whole and make decisions that are goal congruent. So this is exactly the same as the logic that we looked at with residual income. EVA encourages managers to accept investments which yield a return higher than the cost of capital, and it therefore achieves goal congruence, as the interests of the company as a whole are considered. So the only performance measure where we had an issue where managers were not necessarily making goal congruent decisions was when we looked at return on investment. Residual income overcame that disadvantage, and because EVA applies the same mathematical logic, it also overcomes that disadvantage. The next advantage of EVA is managers are encouraged to think the same way as shareholders, as EVA actively encourages the increasing of shareholder wealth. If we have a positive EVA, wealth is created. If we have a negative EVA, wealth is destroyed. EVA adjusts for distortions introduced by generally accepted accounting principles to measure economic performance. So we saw in our calculations, accounting depreciation was added back, and instead we deducted economic depreciation. Also, instead of expensing all of the costs that the company incurred, if there were any costs where there was an enduring benefit or a long-term benefit, those were capitalized, and instead we expense them over the period that we expect to receive the benefit. However, linked to this, we also have a disadvantage because the starting point in our calculation is still accounting profit, which is based on historic costs and not future cash flows. So you can see that actually links to the first disadvantage below. EVA can only provide a rough approximation of economic profit, as the starting point for calculating EVA is accounting profits based on historic costs and not future cash flows. EVA can also assist in identifying underutilized assets. So in our example, we saw we had a negative EVA, and we said one way of improving that is by reducing our asset value. If the asset value comes down, then EVA will increase. So if we do have a negative EVA, it forces the company to look at all of their assets and make sure that they are using those assets effectively. If they are not, they should identify assets that they are not utilizing effectively and sell those assets. And that will then improve the EVA. Then the last advantage of EVA is it puts emphasis on the achievement of long-term goals. So when we looked at return on investment and residual income, you'll remember one of the disadvantages was it emphasized the short term. Managers were discouraged from incurring costs that will have a negative impact on short-term profits, even though they might benefit the company in the long term. And EVA overcomes that disadvantage because where we have costs that are beneficial to the company in the long term, we don't expense all of those costs in 1 year. We capitalize the costs and we expense them over the period that we expect to receive the benefit. So managers are encouraged to incur these costs that will be beneficial to the company in the long term. So in other words, where we have research and development costs, training costs, and marketing costs. And then the last disadvantage of EVA is it requires making a number of subjective adjustments to our accounting data in order to calculate our economic profit and our asset values. So the calculation lacks precision and objectivity. In this lecture, we covered the 3 different methods that can be used to evaluate managerial performance. We looked at the calculation of return on investment, residual income, and EVA. However, please note, that you can use the above three measures that we looked at in this lecture and also any other ratios which indicate the performance of a division where you have an open-ended required. So in other words, guys, you might have a required where they just say evaluate the performance of a manager, and you can see that by performing the calculation of return on investment, residual income, and EVA, you are not going to score enough marks. So please let the mark allocation guide you. These measures that we've looked at in this lecture are the best measures that should be used in order to evaluate performance. However, you can also use other ratios to evaluate performance. You can also calculate gross profit margin, operating profit margin, etc. So please note it is not limited to the three measures that we looked at in this lecture. These three measures are the best measures that you can use in order to evaluate managerial performance. However, if you can see that you are not going to score enough marks by just performing these three calculations, then you can perform any other calculations which also indicate the performance of the division. Then to wrap this lecture up, we need to look at methods that can be used to reduce the dysfunctional consequences of short-term financial measures. Or in other words, what can we do to make sure that managers don't only focus on maximizing short-term profits, but they make decisions that will benefit the company in the long term? So one way that we can do this is by using improved performance measurement techniques such as EVA, because EVA encourages managers to rather focus on the long term instead of expensing costs that will create a long-term benefit. Those costs are capitalized, so managers are not discouraged to incur those costs. Another way that we can make sure that they focus on the long term and not just the short term is to lengthen the performance measurement period. So we don't only evaluate performance over a period of 1 year and then determine whether we are going to pay bonuses or not. Instead, we lengthen that and we look at performance over a period of 3 years or 5 years, etc. However, there is a danger that performance rewards will lose their motivational effects if you do this. If I tell you I'm only going to evaluate your performance in 3 years' time, that's a long time to wait, so you won't be as motivated to achieve the targets. In addition to that, you don't even know if you're still going to be employed with the company in 3 years' time. So that's obviously a danger that you need to consider if you lengthen the performance measurement period. Then another way that we can make sure managers don't only focus on short-term profits, but they also look at what's in the best interest of the company in the long term is by supplementing financial measures with non-financial measures. So in other words, when we are setting targets, we don't only have financial targets that need to be achieved. So we don't only look at return on investment, residual income, EVA. Those are all financial targets. Instead, we also have non-financial measures that need to be achieved. So I've included a few examples over here of non-financial measures. It's things like the market share of the company, the number of clients that they have, the qualifications of their staff members, their productivity level, how innovative are they, what is their product quality like, how competitive are they, what is the speed of delivery, how flexible are they in responding to changes in demand. So those are all examples of non-financial measures which can be used. And the balanced scorecard is a tool which links financial and non-financial performance measures. So this is a tool that companies can use to make sure that they are evaluating both financial and non-financial performance. And the balanced scorecard is broken down into 4 areas. The one focus area is from a financial perspective. We then look at internal business processes. We look at learning and growth. And then we look at things from a customer perspective. So in other words, what is your customer satisfaction like? So the balanced scorecard is a tool that companies can use to make sure that they aren't only focusing on financial performance, but also non-financial performance. So these are all of the different ways that companies can make sure managers are not only focusing on maximizing short-term profits, but they are looking at what is in the best interest of the company in the long term.